Hello guys, and welcome to Financial Flagship. In today's video, we'll be exploring the top 10 investing principles that every beginner should know. So if you're starting your investing journey or simply want to brush up on the basics, you're in the right place. Let me open a whiteboard. So the first principle is setting clear financial goals. Before you start investing, it's essential to understand what you want to achieve. Establishing specific, measurable, attainable, relevant, and time-bound goals will help you guide your investment decisions and help you focus on the bigger picture. Take the time to assess your current financial situation, considering factors such as income, expenses, and existing savings. So you should take into account the income level, expenses, and savings. Next, prioritize your financial objectives and create a roadmap for achieving them. This could involve setting up an emergency fund, paying off high interest debt, or allocating a portion of your income towards your investment goals. Remember, having a clear vision of your financial goals will not only help you stay motivated, but also ensure you take informed choices when building your investment portfolio. 2. We should always start early and invest regularly. Time is your greatest ally when it comes to investing. The earlier you start and the more consistently you invest, the more your wealth will grow thanks to the power of compounding. Compounding is the process where your investment earnings are reinvested, allowing you to earn returns on both your initial investment and the earnings from previous periods. So the most important thing that we should remember from this section is compounding. To make the most of compounding, consider adopting a dollar cost average strategy, a DCA. This involves investing a fixed amount of money, at regular levels, regardless of market conditions. Dollar cost averaging not only helps you develop disciplined investing habits, but also reduces the risk of making poor investment decisions based on short-term market fluctuations. 3. Diversify your portfolio. Diversification is a risk management strategy that involves spreading your investments across different asset classes, industries, and geographical regions. The goal of diversification is to reduce the overall risk of your portfolio by minimizing the impact of individual assets or market fluctuations on your investment returns. Essentially, by not putting all your eggs in one basket, you increase the chances of long-term success and decrease the likelihood of significant losses. So, the thing that we should remember from this principle is don't put all your eggs in one basket. Principle 4. Embrace a long-term perspective. Successful investing requires patience, discipline, and the focus on building wealth over an extended period of time. While it may be tempting to try to time the market or chase short-term gains, such strategies often lead to impulsive decision-making and can result in significant losses. By adopting a long-term mindset, you'll be less likely to react to short-term market fluctuations and more likely to make informed decisions based on fundamentals and overall potential of an investment. 5. Understand risk tolerance. Risk tolerance refers to the level of uncertainty and potential losses you are willing and able to accept in your investment portfolio. It's important to be honest with yourself about your risk tolerance, as it will play a crucial role in guiding your investment decisions and determining the appropriate mix of assets in your portfolio. Factors such as age, financial goals, investment horizon, and personal temperament can all impact your risk tolerance. The sixth principle is invest in what you know. As an investor, it's essential to make informed decisions by researching and investing in companies, industries, or asset classes that you're familiar with or have a keen interest in it. This approach, famously advocated by legendary investor Warren Buffett, can help you gain a deeper understanding of the underlying business model, industry trends, and potential risks associated with your investments, reducing the likelihood of making costly mistakes. To begin investing in what you know, start by identifying areas where you have expertise or personal experience. This could be your current profession, hobbies, or industries you're passionate about. Conduct thorough research on the companies or assets with those areas, analyzing factors such as financial health, competitive advantages, and growth prospects. By focusing on areas you're knowledgeable about, you'll be better equipped to spot investment opportunities and make educated decisions that align with your long term financial goals. As you grow more confident in your investment abilities, you can gradually expand your focus and explore new sectors or asset classes, but always remember the importance of due diligence and informed decision making. The seventh principle: keep costs low. As an investor, it's important to be mindful of the fees and expenses associated with your investments, as high costs can significantly eat away at your returns over time. These costs may include brokerage fees, management fees, expense ratios, and taxes. By choosing low cost investment options and minimizing unnecessary expenses, you can maximize your potential returns and achieve better long term performance. One way to keep costs low is by investing in low cost index funds or exchange trading funds like ETFs instead of actively managed funds, which have higher fees. Additionally, consider using a low cost brokerage platform that offers competitive trading fees and account management services. Furthermore, conscious of tax implications and employ tax efficient strategies. Hold investments for over a year to benefit from lower long term capital gains tax rates. By being cost conscious and actively managing investment expenses, you can significantly enhance your net returns and grow your wealth more efficiently. Principle number 8: avoid emotional decision making. Emotions can be a major obstacle to successful investing, as they often lead to impulsive and irrational decisions that can negatively impact your investment returns. Fear and greed, in particular, can cause investors to panic sell during market downturns or buy into hype during market bubbles, ultimately resulting in poor investment outcomes. So these are the things that we have to avoid. The two big forces in trading and investment: fear and greed. Principle number 9: continuously educate yourself. The world of investing is constantly evolving, with new investment products, strategies, and market trends emerging regularly. To stay ahead of the curve and make informed decisions, it's crucial to keep learning and expanding your knowledge base. This involves staying up to date with market news, studying different investment strategies, and familiarizing yourself with various asset classes and financial instruments. There are numerous resources available to help you learn more about investing and personal finance. These include books, online courses, webinars, podcasts, and blogs. Additionally, consider following industry experts, financial news outlets, and reputable investment research platforms to stay informed about the latest market developments and trends. And the last principle, principle number 10: review and adjust your portfolio periodically. Over time, your financial goals, risk tolerance, and investment horizon may change, requiring adjustments to your investment strategy and portfolio allocation. Furthermore, market fluctuations can cause your portfolio's asset allocation to drift away from its target, leading to a potentially riskier or less diversified portfolio than you initially intended. To maintain a well-balanced portfolio and stay on track to achieve your financial goals, it's essential to regularly review and rebalance your investments. Rebalancing involves selling instruments that have grown disproportionately in value and using the proceeds to buy underrepresented assets, bringing your portfolio back to its target allocation. We have target allocation. This process not only ensures your portfolio remains aligned with your risk tolerance and investment objectives, but also promotes a disciplined approach to buying low and selling high. It's generally recommended to review and rebalance your portfolio at least once a year, or when there is a significant change in your financial situation or goals. In conclusion, understanding and applying these top 10 investing principles can greatly increase your chances of success as a beginner investor. Remember to set clear financial goals, start early, diversify your portfolio, and stay disciplined in your approach. Investing can be a very rewarding journey, and by following these principles, you'll be well on your way to building long term wealth. If you found this video helpful, please give us a thumbs up and share it with your friends who may also be starting their investment and trading journey. For more investing and trading tips, don't forget to subscribe to our channel and hit the notification bell to stay updated on our latest content. If you have any questions or suggestions for future video topics, leave them in the comments below. Thank you for watching and happy investing!